So the next paper is going to be about post-COVID-19 exit strategies from a perspective of emerging markets. Both Joshua and Hiro are here. I'm not sure which one of the two will speak more. Go ahead.
Thank you very much for the opportunity to discuss today with Hiro post-COVID-19 exit strategies and emerging markets economic challenges. We will split the presentation equally. So let me jump to the motivation. The pandemic generated a massive decline in the growth rates of most countries, as is indicated in this chart. And this, in turn, generated a massive spell of fiscal stimulus. And the US has been the leader. If you look at the timeline, in March 2020, the stimulus in the US was about 2 trillion, about another trillion in December 2020, then close to 2 trillions in March 2021, and probably another more than trillion, maybe 2 trillion in the coming year or years. To put it into a time perspective, figure 2 here is focusing on the history of the US, focusing on the pattern from 1940 until present and projected trends, focusing on the trend of fiscal deficits to the GDP. And here you can see that the stimulus in the US in 2020 was practically twice the stimulus that happened in 2009, the peak year of the crisis. And notice also that the trend towards growing deficits has started roughly in the mid-2000s. Now, turning to the chart dubbed here as 3B, you can depict this in terms of the patterns of the ratio of public debt to GDP in the US from 1900. And if you are looking at the big picture, we are located now at the range of public debt to GDP, which is practically the same as the one that was observed in the US at the end of the Second War. The main difference is that we know from history that the US adopted an interesting combination of policies that managed within about 25 years, cutting the deficit from about 110%, and this is the public debt held by the public, into a ratio that approached below 30 in the 70s. In contrast, the present projection is that the future decades are entailing massive expansion of the deficits, and the projection is that within 2 or 3 decades, we may hit the range of 200%. Now, this, of course, raises the important question, is the US debt sustainable? And of course, this is not a US issue alone, it's a global issue because the US remains the anchor of the global financial system. So far, no credible competitors to the US has emerged. In this chart that was taken from the presentation of Carney in 2019, we can note that the US, which is commanding now in terms of the global GDP share adjusted for PPP, well below 18%, in terms of the importance, global importance of the dollar, it is anything between 50 to 70%, depending on the number and the characterization that you would like to focus on. So this suggests that instability and unsustainability of the trajectory of the public debt of the US will be translated with a short lag into a global issue that will hit probably first the emerging markets, and there will be also secondary important effects on other OECD countries. So in order to gauge what the past experience is telling us, in this paper we contrast two divergent exit strategies of the US from the COVID debt overhang and analyze their implications on emerging markets and global stability. So in a nutshell, this is an empirical paper that is looking at the history of this issue in the context of the past 75 years and is trying to identify the impact of these two divergent strategies. Of course, these are two extreme strategies that we are outlining, and we believe that the future will entail a moving weighted average between two extreme strategies. So strategy one is the US aiming at the return to the pre-COVID mode of loose fiscal policy and accommodating monetary policy. Now, we argue that the benefit of this strategy includes faster economic growth as long as snowball effect, which is defined traditionally as the gap between the interest rate on public debt and the growth rate of the GDP, is negative. However, this strategy entails also a growing over time tail risk of a deeper crisis that may be triggered by a future reversal of the snowball effect, inducing potentially a deeper future sudden stop crisis and instability of emerging markets and potentially of other OECD countries. Now, we illustrate this scenario in the data by evaluating emerging markets' lost growth decade during the 1980s, triggered by the large reversal of the US snowball effect during the second half of the 70s and the first half of the 80s. Next, the second strategy entails a more complex two-pronged approach. First, turning US fiscal priorities from fighting COVID medical and economic challenges towards investing in social, medical, and physical infrastructure. Then, with a lag, once the growth of the US recovered enough, promoting a gradual fiscal adjustment aiming at reaching, over time, primary surpluses and debt resilience. And we argue by looking at the data that de facto this was the strategy that, in retrospect, is characterizing the exit from the debt overhang of the Second War. And within 20 years, this strategy seemed to deliver positive global externalities. Now, we illustrate this by reviewing the exit strategy and focusing on the phonics emergence of Western Europe and Japan from the Second War. And with lag, we know that this definitely also helped the emerging markets. We conclude that the contrast between the two strategies suggests that a two-pronged approach is akin to upfront investment in greater long-term global stability. We also empirically showed that lowering the cost of serving public debt has been associated with the lag, and we characterize the lags with higher output growth, and the opposite applies too. So the snowball effect is really the cornerstone of this dynamic equation that is telling us that the growth in national debt is related to the snowball effect multiplied by the national debt plus the primary budgetary deficit. And this equation is the cornerstone of a numerous number of papers that are using it to generate to characterize the dynamics of adjustment. And the Blanchard paper of a year ago is only one example, and one can think about hundreds of papers along this line. What we are calling the first strategy is dubbed, or was dubbed, as kicking the can down the road. And the main idea is that the loose fiscal and monetary policy in the short run encourages economic growth, and this will continue until the economy is hitting a fiscal wall, and this will happen when the interest rate will start rising. And with a lag, this, depending on the past exposure to debt overhang, will tend to generate lower growth rate, ending up potentially with the fiscal stone wall, which to a degree is the characterization of what happened to the emerging markets during the 80s. Now, the story in a nutshell is that when this happens, fragility grows, and it impacts mostly the more exposed countries, which typically are the emerging markets. It generates exposure to multiple equilibria with self-fulfilling debt crisis. And the prime example here is the Latin American debt crisis in the 80s. Similar crisis, though weaker, characterized various countries in Asia. And to a degree, the Euro debt crisis of the Eurozone periphery in the 2000s has strong flavors along this line. The mechanism here is well known. The characterization here is that the US appreciation that is characterized by a hike in the interest rate of the type that we have seen, say, in the early 80s, induces large real depreciation of exposed emerging markets. With a lag, the debt burden increases massively in terms of local purchasing power. We can observe this adjustment where the collapsing growth rate induces bankruptcies, inducing also capital flights that are magnifying the real exchange depreciation, generating a full-blown crisis. Now, the second strategy entails, if everything works well, to a trajectory where over time, the growing primary surplus that is associated with it, once that the higher investment in infrastructure is translated into a higher output growth, may lead to an opposite, if you wish, cycle where the interest rate goes down, and with a lag, it may encourage higher growth rate. And this is really, in a nutshell, the mechanism that we are trying to identify in the data. So let me stop here and let me turn to Hiro's presentation, please.
Okay, you have only 5 more minutes, Hiro.
Okay, Joshua talked about snowball effect, or the net interest rate, or interest rate growth benefit differentials. So those are sort of interchangeably used terminology. Now from there, we can see what the data tell us. So this figure shows the development of interest rate growth differentials over time since 1945, and the red line shows the median of the sample of 54 countries included in this analysis. Then dotted blue lines represent 25th and 75th percentile of the interest rate growth differentials. So what you can see here is that in the 1940s through the 1970s, the net interest rate was negative. And that really helped heavily indebted economies such as Western European countries, Japan, and the US after the Second World War to pay off their debt. And at the same time, they were able to experience fast economic growth. Then opposite case is true for the Latin American economies in the 1980s, where the net interest rate turns to be in the positive territory. Then if you look at the 75th percentile line, you can see some economies experience very high interest rate growth differentials. So the data tell us that there's sort of a generalization where higher cost of servicing debt can lead to slower economic growth. So with that observation, why don't we take a look at this case more formally using a regression model. So we run a growth regression where we have the per capita real output growth on the left-hand side, and we regress that on the cost of servicing public debt. When I say the cost of servicing gross public debt, what I mean here is the product between the net interest rate, or the change in the net interest rate, and the growth ratio, the debt ratio. So the product is what we call the cost of servicing gross public debt. Then we are interested in how the cost of servicing public debt would affect the economic growth. So what we are interested in is the signs of these betas. We have the three lags, then we are interested in the sign of the three estimated betas. Then if the estimated betas turn out to be negative, that means that is consistent with our prior. So what are the findings? Yes, the findings are all of the betas turn out to be significantly negative. So that means that higher cost of servicing gross public debt dampens the per capita real output growth, as we expected. And to get a better and more intuitive understanding, I'd like to show you the actual contributions of the cost of servicing gross debt to annual output growth rates. So basically, we have now the estimated beta, and we have the actual data for the cost of servicing public debt. Then that can show what is the impact of the cost of servicing public debt. So the orange bars represent the median in the country sample, and the red star represents the 25th percentile, and blue stars represents 75 percentile of the cost of servicing gross public debt. So what we can see here is that, especially if you look at the panel for the full sample and also for the advanced economies, in the 1960s, the impact of the cost of servicing gross public debt turned out to be positive. So that's because the net interest is negative, and that helps these economies to pay off their debt, and that can grow faster.
Okay, one more minute.
Yes, if you look at a group of developing and emerging market economies, you can see the opposite. So if you focus on the 1980s, the impact is negative. So that is because the snowball impact for those economies is so high that the debt sustainability issues very much dampen their economic growth. Then if we look at the subsamples of Latin American economies and Asian economies, we can see again the negative impact of the cost of servicing debt for the Latin American economies in the late 1970s through the late 1980s. And for the subgroup of Asian economies, we see such a negative impact only for the first half of the 1980s, possibly reflecting the situation of South Korea, but not for the other time periods. So again, we can see that if the cost of servicing gross debt is higher, then that can dampen economic growth. Then we also run the regression by disaggregating debt variable into domestic and external. Then we again see the same kind of impact. So it also applies to domestic and external debt issue as well. So that's what we find. And I guess because of the time constraint, I'll skip the conclusion. Thank you very much.
Okay, thank you very much to both of you for the presentation. I'll open the floor for questions. Michael has a question on the chat, which I think only the panelists can read, that says, do you distinguish dollar debt from other currency debt?
Yes, and the other is not in terms of other currencies. Everything is translated to the dollar, but we are sensitive to the possibility that more and more countries are maturing gradually from the original sin. So as Hiro mentioned a minute ago, in the regressions, we don't have the time to review it, we are paying attention both to the local debt that is funded by foreign parties, which for a fair share of emerging markets is playing a growing share, and then for the foreign funding in hard currencies. And the results are overall robust to this.
And I have a question about, I understand why you put the US at the center of some of the story, but when I look at the 1980s or the 1990s crisis in emerging markets, those were decades where interest rates were really high, and they were really high across the world, and US debt was not that high. So obviously, there's a reason why interest rates move, and it puts emerging markets at the edge of a financial crisis. So again, as we look forward, is it going to be the U.S. debt, or is it going to be a shift in global interest rates for whatever reason interest rates might come back up? How much the U.S. will be the person or the country to blame versus some global trend towards higher interest rates?
Well, if you are looking more at the details of the 70s and the 80s, so then it's fair to say that in the early 70s, because of the energy crisis and the dynamics of the petrodollars, the global interest rate was very low. And this was the time that emerging markets downloaded themselves. Now, the impetus generating really the crisis of the 80s, I believe, was precisely the US, when the inflation in the US on quarterly basis in 79 reached, if I recall, on quarterly basis, close to 17%. And then Volcker was the one that cooled off the US economy. And this, I believe, was the mechanism that propagated with the lag of 2 or 3 years, the massive collapse of Latin America and several other countries in the various regions. Now, your question is very important. As long as the US dollar will remain the currency of choice for most of the debt, and as long as we don't have a meaningful competition by either the Eurozone or China, so we cannot rule out that similar trajectory will happen if and when the US will face the same configuration of higher interest rate, and with a lag, maybe a marginally low growth rate. And the propagation mechanism will be similar up to the adjustment for the fact that some of the countries are not subject to the original sin, but we know from a paper that was presented by Patel and co-authors in this conference, I think 3 days ago, that this by itself is not the end of the exposure of emerging markets to the impact of real exchange rates. So the main point is changes of the real exchange rate that may be propagated either by developments in the US or in Europe or in China will have, I believe, similar effect on emerging markets. But of course, this will be related to the debt overhang of the emerging markets and the quality of the adjustment of macro policies. So you are right that there is no guarantee that the next 20 years will be like the history that we portray, but the main mechanism of the adverse effect of massive real depreciation that may hit emerging markets, I believe it's a robust mechanism that will play its ugly head. The biggest uncertainty is when the snowball effect will increase sharply, and we know that this is the biggest unknown that we can think about the exposure to risk of emerging markets.
Michael has a question.
Josh, another issue that, an alternative scenario, I guess, that you can't deal with in this paper is the issue of the sustainability of the debt under any interest rate realization. So, if you look at those pictures of US debt in 2040 and for other countries, the question is that whether we're going to see some debt default, sovereign default, among some advanced economies, or whether we're going to see, de facto defaults through very high rates of inflation. So, that's not that's not a good outcome, but perhaps it would be a different outcome than the kind of snowball effect that you mentioned. I'm just kind of wondering, do you have any conjectures about that alternative scenario? So
let me point out 2 things. The first is that the projection of the continuation of a path of the US is conditional on no changes in the present taxation.
Right.
Now, we know that after the Second War, this was not the case. So this refers to the scenario of the 2-pronged approach. So if by chance there be collective willingness in the US to follow higher taxes. And after all, the US is subject to a much lower tax burden relative to the EU. So there is, in principle, enough room to move over time when the growth rate is going up towards maybe primary fiscal surplus. This may mitigate a lot of these trajectories. Now, going back to your point, we know that history has a lot of examples of a combination of adjustment by all the margins that you mentioned. And we know that our data is not covering the period of the 30s, but Sebastian Edwards wrote a nice book about the default de facto of the US, the economic default, once that the US gave up the peg to the gold standard. Now, we can only indicate that the farther away that the US will be away from the second strategy, the greater will be the impact down the road of any sharp rise in the snowball effect. And there I agree that we'll see a combination of all the options that you mentioned. But again, we should expect that countries that are ex ante in a much better situation will be exposed less to this versus countries that are not there. And the empirical mechanism allows us ex ante also to rank these countries. And this is something that is partially reflected, but not fully, in the credit rating and sovereign spreads. But I don't believe that there is one-to-one clear correspondence between all these factors.
Okay, thank you, Joshua. Apologies that I keep cutting everyone, but we're going to move to our third paper just to make sure that we stay on time.
Thank you for the comment.
Thank you.